Hello, everybody. I'm your boss, Joe Boss, and welcome to another daily plan stream. Appreciate all you guys for watching. We got a lot of geopolitical stuff coming through the docket this week, and I know we got a lot of economic events, especially economic events around manufacturing. If I go to the calendar real quick, you can see a U.S. manufacturing index, industrial manufacturing just came out, and it grew in the Euro area. We have GDP coming out, wholesale, zoo economic index, housing in the U.S. Reuters Tankan, which is essentially a manufacturing-based index, I believe. Yeah, sentiment index for manufacturers. And then sprinkled throughout every single trading day for, pretty much every single day, we have Fed speech and then Fed speeches and BoJ speeches. There's a lot of manufacturing data, some inflation data, and we're getting a slew of G7 central bank speeches this week. I think those are going to be the highlights. Depending on how each individual country's inflation and manufacturing and central bank speeches come out, we can see some rather idiosyncratic moves here. My net expectation into the week is still a stronger dollar, a more sideways equity market that recovers from recent drops. Commodities to continue rising. I mean, you can just look at crude. It did take a hit here recently. It followed our expectations, though, you can see that much. We had a negative expectation, and this was actually without the... right around here. We had a bunch of news around getting involved with Israel and its moving oil prices lower. Not only that, but there's been flooding in Russia, and that's taking more oil supply offline. It's not looking so great for the oil supply side of these stories. And if the manufacturing components for all these economic indicators, Philadelphia Fed manufacturing on Thursday, and then look, 3 speeches like back to back on Friday. Let's see here, RBA Bulletin. Yeah, again, it's central bank speeches, manufacturing, and inflation. And, Canada has some inflation coming out tomorrow here. Couldn't check out the good old Canadian. Yeah, that looks pretty good in my opinion here. Yeah, give me a sec. That looks pretty good. And then again, going into potentially lower Canadian inflation tomorrow. Quite likely Canadian inflation comes in lower. Let's see here. Inflation month over month. Yeah, previous 0.3, consensus 0.7, forecast 0.3. We'll see. We'll see. Either way, what is it? We're getting a central banker out of Canada speaking shortly after these inflation prints. So about 5 hours after inflation, we're going to get Bank of Canada speech come out, and it'll probably be Macklem will probably say something along the lines of, "Oh, we're still open to continuing our current path from what we said in our prior speeches, which is just more cuts out of the Bank of Canada." Man, I'm just thinking this is going to be a bit of a dicey week to set expectations for, because jumping between setting expectations for the manufacturing and the inflation economic data plus all these central bank speeches is going to create a little bit of volatility here. Because those central bankers are going to play off the manufacturing and inflation data that comes out this week. But that doesn't go for every central bank, because not every single country is getting manufacturing and inflation data this week. So obviously the countries that are going to be getting more data are likely to move more this week. But that's the point. They're only likely. The expectations for the future expectations, what's a good way to put this? Depending on how the current economic data prints, it needs to be compared to what we already are expecting for the future. So we're not necessarily comparing the good or the bad performance that we immediately get and trading on that. We're comparing the information we get, the new information we get this week, with how well that data lines up with our future expectations. And if the data moves significantly, it can change our future expectations. But when I look at this and I look at the consensus views and I look at what type of data is printing here, in my opinion, outside of explicitly the central bank speeches that we're getting this week, I think it's going to be pretty range bound, most likely. So unless there's, something that happens in these speeches that changes the expectations of the central bank, and I actually don't see these speeches moving all that much. I mean, maybe here for the Bank of Canada, Macklem, he doubles down on the continuation of just, hey, we're going to do whatever it is we can on the the central bank side of the rate policy stuff that we can do with the Canadian economy. These are more fiscal problems that we're now dealing with. So we're going to back off from the economy. We're going to do our rate cuts. And then you do have Bailey, essentially anyone with Gov, right? The governor of these central banks. If they come out and they say anything, it's probably going to be status quo. From what I understand with the Bank of England specifically, there's a risk that they do more cuts if the data comes out nominal, right? Which is kind of what people want ultimately. They want the data to come out nominal, and they want Bailey to come out here and say we're more open minded about taking cuts seriously going forward. Now that would send the pound lower, but it would make money a little bit more easily available. And when you have other G7 central banks outside of the United States following that train of thought, where their inflation is improving, their growth is improving, and they're loosening monetary conditions, so that then banks can give out loans to businesses, and then 2, 3, 4, 5 months later, you start to see actual significant growth in these economies. Well, then that starts lining up with the future expectations that a lot of large institutions are expecting, which is the growth in all of these other G7 countries, except for the United States. Their growth improves, their inflation goes lower and improves, and in such a significant fashion that they outperform the United States. And if you look at forecasts for like the second half of the year, a lot of institutions are setting this as their expectation for why they think the dollar is going to fall in the second half of the year. So if you ever read an outlook and they say, we think the US dollar is going to fall into the second half of the year, this is kind of what they're expecting. But there are a series of blocks that kind of have to get built up before people can actually execute on that. And the information we're getting this week is going to either assist those expectations, or it's going to start making people concerned about potentially missing those expectations and the dollar getting stronger over the summer. Because we already kind of have the expectation of a stronger Fed and higher for longer Fed and higher for longer inflation in the United States. Now it's a matter of, does inflation go lower in the rest of the G7? Does growth improve in the rest of the G7? Is, you could say is fiscal and monetary policy tight or loose? And is it going in the direction of loosening? If those three things are met, then those economies are gonna look pretty good going into the summer and going into Q4, to be frank. Things are probably going to improve a lot more significantly if we get those expectations. So the thing that I'm saying that would subvert those nominal expectations that a lot of institutions currently have is if manufacturing improves. We can kind of just hand wave the manufacturing economic data just, with our own discretion and say, let's just assume that data comes in good. That's going to help drive up commodities prices. That's going to help drive growth. That will assist China. So everything should be hopefully fine in China. That should be good. The inflation rates across these countries also have to continue coming down lower, but if they start getting sticky at this point, like in the United States, then you're gonna probably push out forward your first rate cut expectation for, like, let's say if this inflation metric here in Canada comes in lower, we're probably still going to get our first rate cut for the Bank of Canada, June. But if this thing comes in sticky, this thing comes in higher for whatever reason, and it surprises to the upside, the probability of a Bank of Canada cut becomes like 50-50. And that's what makes this week a little more dynamic and like a very hot potato. This is constantly getting passed around from hand to hand because you have all these central bankers trying to get their opinions through and all this economic data from these G7 countries. And it's not going to be an easy week, I think, to say the least. Just to say the least. We'll probably be able, in hindsight, right, in this upcoming Friday or Saturday, be able to review this data and then figure out, okay, now that we actually have all this data and we've been able to review what all these central bankers are saying, now let's go ahead and update our expectations for kind of what we should be expecting going into the end of April and into May, right? Let's see here. Any new news from Financial Juice here? We had economic indicators. Oh, okay, so we got an ECB speech coming out here, and these are the headlines. So ECB's Lane came out, said a few things. Near-term inflation is to fluctuate near the current level. So this is not good. That's a sticky inflation comment. While services inflation should decline somewhat in the near term, it's expected to remain elevated for most of this year. Yeah. And again, if you have manufacturing growth increasing and the supply for manufacturing commodities decreasing, you're going to see a huge inflationary rise in the cost of goods. And that will probably hit us sometime during the summer or later into Q3. So I would add to this that looking forward, there is a real risk of not just sticky services inflation, but accelerating goods inflation in the months to come ahead. And then all of these rate cuts that we're expecting, for example, out of, let's say, the ECB, we might get a rate cut in June, and then they hold off until like December, essentially like 2 or 3 rate cuts. Because I think there's currently 4 or 5 rate cuts priced in right now for the ECB. If commodity, if oil. If oil were to suddenly jump next month to, let's go ahead and pull up our ranges here. Look at our highs here for next month here in May. Wow. That is really, I mean, it's nice to see 41% of the time, the top next month in May on oil comes in between R0.5, R1. It's pretty high probability. But then see how here, past this R1 pivot, everything's like 12, 7, 12, 4. The odds get real thin and spread out over a wide price range. That doesn't make me feel too comfortable setting an expectation as to where the top comes in next month. You could use this, but then again, these price locations are not accurate. These are kind of based off where we are currently priced. So again, in about 2 weeks, we'll have a more accurate view of where these targets for May could end up. But yeah, this is going to be pretty tricky because even though I didn't see it there on the May chart, I have a sneaking suspicion you're going to crack this. Because in my opinion now, especially after this flooding that's occurred in Russia and these attacks on, these drone attacks on their refineries, and And Biden is trying to take more supply offline, apparently. It's really, really not looking good. And the Saudis keep extending their oil cuts, their oil supply cuts. It's really not looking good. I think that there's a spike risk for oil to, like, in a potentially like 1 to 3 week period, let's just say 2 weeks, split it down the middle. In some 2 week period over like the next quarter, or like during the summer, I think there's a real risk of going above $100 on oil due to all these supply constraint risks coming through. And I'm concerned about that because $100 oil would absolutely force manufacturers to pass on higher costs to their consumers. And then there you go, you have reaccelerating goods inflation. Not the best outlook in the world. But I don't hear anyone saying that specifically. The relationship between future expected goods inflation and the relationship it kind of has with this overall rise and expected continued rise in commodities prices. So you have this reacceleration in goods inflation potentially into the summer, and your services inflation stays flat. It can really give some strong inflation prints throughout the summer. And if that ends up being the case, then just wave goodbye to every single central bank's future expected, rate cut path. The rate cut paths go to like 50% probability of one cut for all the G7 central banks. And I know I'm kind of getting speculative, right? But these supply constraints in the oil market can have some pretty significant ramifications on goods inflation. And who knows, maybe expecting that move in summertime might actually be too early, because usually there's a lag period between when higher prices in manufacturing, wholesale manufacturing, products actually get the price increases for manufacturing actually get passed down to the consumer. There's kind of a lag, a multi-month lag there. But I'd expect sometime during the summer or towards the end of Q3 to actually see those moves. I mean, I've now kind of done my 30 minutes of rant. So, U.S. retail sales, good. Finally, something else to talk about here. Oh my God, the U.S. economy is getting stronger. That is a very strong retail sales print. This is going to send the dollar higher. And real quick, I need to draw something for you guys here. You heard me talk about it here on the stream. I mean, I didn't explicitly say I was doing this, but I think if you were listening to what I was saying, like, oh, I need to pay attention to this. Let me just go ahead and do my drawing real quick. And I'll post this in the trading group when I'm all set. Let's see here. What's the price exactly that I hopped in here at? I wouldn't be surprised if that's the low for the week, to be frank, because the Bank of Canada is in definitely one of the weaker positions in the G7 to get long on the US dollar side against, essentially using the Canadian as the funding currency. Let's see. So the entry is... Yeah, that's a good entry. Let's use the daily range probabilities to figure out where I should put my stop loss here. And that was simple, right? And for anyone who doesn't know, the simplest way to interpret, you know, let's say, hey, you're looking at this peak here in the distribution of where daily lows come in, and you want to take your shot here. Where does the stop go? The easiest way to remember this is with a little mnemonic. Trade the peaks and stops at troughs. Oh, so the dollar's up. The S&P and why would S&P be down? I thought the S&P would go up on this. Let's see here. Oh, and I've been having this thing going on with TradingView. For some reason, it's been taking a while for TradingView to load my charts today. Here, I'm gonna save this. Oh, hold on a sec. There we go. I had hid the drawings. Yeah, that's all. Yeah, this looks like... Oh, so it did something funny right on the 5 minute. Yeah, what time frame is this in? Yeah. So on the release it jumped down, but obviously that doesn't make sense for this report because this is very good US growth and that's very good for equities. Wow, check that out. Retail sales year over year is really good. Fed Williams. Consumer spending is driven by strong fundamentals. Yeah, so stock market's probably going to continue going up from here. I wouldn't be surprised if that's the low here. Yeah, I wouldn't be surprised if that's actually the low for the week and we end up doing something along these lines here. There goes Joe, drawing another one of his expectations. Yep, up like that. And let's check out NQ as well. Yeah, NQ has a bit more variability. Let's check out the timing dots real quick here. Yeah, I'd say nominally something along those lines. And the timing dots are a new indicator. Everyone in the trading group now has access to them. I'll go over it some other time. Oh, wow, yeah, this thing. Look at those yield spreads. Those yield spreads are so negative, man. Yeah, this thing's probably going to go straight down. And check this thing out here with the timing dots on the month. I need to actually increase this to 1%. Depending on the time frame you use, you probably need to adjust the settings a little bit, to be frank. Oh, I think I need to set this to 0.5%. There we go. Yeah, there you go. So this is looking at every single historical month and finding highs that are similar to the current high of the month in this little red box here. And it's checking where likely lows follow from this high. So the red box gives us a list of red dots. So given this is the high for the month, these are the dots that have followed historically. And then vice versa for this green stuff here. And you can see we have a cluster of dots around this area here. and then this area over here. So I kind of see one or two scenarios, and this is my expectation, my scenario here that I'm setting. And I sure hope we hit 105, because I would really like to buy like sub 105 on the month and do something like this, take it into a close. And here's something interesting. You can actually look at these close lines. So it just draws, hey, when you got the low here, where did it end up closing? And you can kind of see that we get a cluster of closes here and a cluster of closes there. So looks like the way I drew this arrow lines up with how a lot of similar lows in this area here, in this area here, end up around the end of the month. Looks good. Looking good to me. Okay. Let's see. Let me head back to $CAD here. Let's hide those dots. I don't need them now. Just expand this out. Let's see here. Pretty sure I screwed up the, I think that's what, 244. Yeah, I really screwed that up. Let's see here. Fed Williams, I don't see the recent inflation data as a turning point. Yeah, I'd agree. Oh, it's backwards. It's 422. There we go. That's the entry. Keep it nice and simple. It just extend it out into history a little bit. And pull this up. Let's go ahead and check some weekly targets here for us. And as you can see, we're at a likely low for the week here, and our yield spreads, outside of the yield spreads for today, the long term and intermediate term yield spreads are improving. And who knows, maybe by the end of the day, these yield spreads will flip a bit more green, but that actually is not so hot, in my opinion. I'd like to see all this red here go away and get green. Let's see here. We can actually use the timing dots here. I'm gonna turn off those closed lines. So let's see here. Also, I'm gonna reduce the percentage a bit. So when the low for the week is in this area here, the highs end up looking something like this. At the most earliest time. And given we have CPI coming out for Canada, I actually would not be so surprised if we actually got this sort of move. That would be 150 pips, man. That's a lot. Now the question is to ask, is that a reasonable expectation? Well, if inflation essentially stays the same, And then Macklem comes out and gives a speech that's exactly tonally the same as the last one he gave. It's not going to change the future expectations, I think, for the Canadian dollar. It'll probably just continue getting weaker. So we'll see. We'll see going from here. Fed Williams has said quite a few things. I'm getting more optimistic about potential growth. That's nice to see. And nice to hear. Any particular charts you guys want me to pull up? Because outside of the, let's see, handful of things that I can check. Yep, it looks like we're seeing follow through here as well on the crypto side of things. Probably want to set this to like 1% search. Yeah. So given the low here for the week, we have quite a wide dispersion of highs. A lot of lows are made around this price here. Yeah, if this ends up being the high, given that's the high for the week, a lot of the lows for the week are made somewhere around here. But I'm not too sure that high is going to hold. Let's assume this is the low for the week. Yeah, there's way too much price variability. I mean, the high comes in most likely sometime during these bars here, so what's that? Sometime in the next 2 days, you either get a top on Bitcoin where you end up doing something like a rally into a new high at the end of the week. Again, that's just given the current low. That's all. So if we make a new low somewhere around here, these dots will update, and then we can update our future expectations. Okay, anything else to check out here? How about New Zealand? Let's turn off those dots real quick. Yield spreads are still super negative. Super negative yield spreads. Yeah, this thing looks like it's gonna definitely get hit lower. Just waiting for the probability pivots to update. Yeah, so most of the lows are around here, like in the next 50 pips. But I'd worry past 59. Past 59, it starts to kind of become a guess as to where the low ends up. And it seems like that's exactly what the ranges are saying. It's like, hey, either you're finding your low like just below 59, or it becomes a guessing game below here where the low comes in on euro dollar. I would still have my negative bias with these negative yield spreads, though. All right, you guys. Let's go ahead and see how this little dollar CAD trade develops over the rest of this week. We'll end up following up on a lot of these economic data points here. And yeah, just a nice, chill, straightforward stream. Super, super chill stream. All right, you guys. I got not much else to say here, so I'm going to go ahead and hop off the stream and get to programming and get to running some errands I got to run. So I will see you guys in a bit.